Right now, American equity markets look stable. Traders are buying, algorithms are humming, and the general mood is business as usual. But 7,000 miles away, the physical reality of global trade has frozen solid. This is the undeniable metric of the crisis. Daily oil tanker transits through the Strait of Hormuz have plummeted and effectively flatlined at zero. Despite this, the consensus in Washington is that this is a brief interruption, a standoff the U.S. military will resolve with a quick show of force. That calm is being maintained by behind-the-scenes manipulation. While oil in New York trades around $93 a barrel, the physical price for crude in Oman recently reached $173. Western markets are being shielded from real price discovery. Global markets are trading on political rhetoric, ignoring the mathematical reality of physical supply chains. This is a map of the Strait of Hormuz. At its narrowest point, the corridor is just 22 miles wide. This bottleneck strips and matter navy of maneuverability. Massive ships have no room to evade. They must travel in a predictable, single-file line. This vulnerability has forced an unprecedented retreat. The U.S. Navy has withdrawn its aircraft carriers 750 to 1,000 kilometers away into the open Indian Ocean. The carriers moved because of an asymmetric threat: cheap land-based ballistic missiles and drone swarms. A land-based power using drones and missiles has effectively stood off the U.S. Navy, keeping the waterway closed through pure geography. The conflict has exposed a core military asymmetry. The U.S. defense industrial base is struggling to keep pace with a sustained low-cost barrage. This is a matter of production limits. Currently, the U.S. can only manufacture 1 to 2 of these high-tech interceptor missiles per day. Meanwhile, the adversary is firing daily barrages of 10 to 30 drones and missiles, using precise Russian satellite intel to find their targets. This comparison shows the industrial dead end. The U.S. military will simply run out of interceptors long before the adversary runs out of cheap drones. Projecting this forward over several months, the interceptor stockpile completely depletes. The adversary can afford to maintain this bombardment for a year or more, creating a permanent no-go zone for U.S. forces. In this environment, air dominance rests on raw industrial output, a cycle of depletion that the U.S. military is currently mathematically incapable of winning. With the Navy blocked, some are calling for a ground invasion to seize strategic islands and manually force the strait open. Military professionals view this as a trap. They compare it to historical quagmires where high-casualty operations failed to achieve their primary strategic goals. Neutralizing the drone threat requires hunting mobile launchers hidden across a rugged, mountainous country half the size of the United States. This difficulty is already apparent. The sheer accuracy of the adversary's targeting has already forced U.S. personnel to evacuate multiple regional bases. Proposing a ground war to fix a naval blockade ignores the mathematical deficit of the airspace. It only provides more targets for an unwinnable geographic trap. As the military stalemate continues, the global economic clock is rapidly ticking down. The first major supply chain domino to fall is the export of liquefied natural gas and critical helium from the Gulf. Because Taiwan relies on these specific raw materials, their microchip manufacturing industry is facing an immediate paralysis. This creates a mathematical dead end for the U.S. 200% of the growth in American consumer spending comes from capital gains and taxable IRA distributions. If the Taiwanese chip freeze halts the tech sector, the NASDAQ falls and that growth engine stops immediately. The contagion then spreads to the bond market. Foreign financiers own $9.5 trillion in U.S. treasuries. To secure energy in a global shortage, they will sell that debt to buy fuel, driving up yields exactly when the U.S. fiscal position can least afford a recession. The U.S. economy is entirely exposed. If the strait remains closed for just a few more weeks, the tech sector and consumer markets face a total crash. This standoff mirrors the geopolitical shift of the 1956 Suez Crisis. In 1956, the world realized the British Empire's naval dominance had ended, signaling the transition to American hegemony. For 4 centuries, power has rested on a single doctrine: whoever controls the world's naval choke points controls the global economy. For the first time in centuries, the world has seen that land-based missiles and drones can effectively neutralize the protection a global navy is supposed to provide. This fractures the incentive to pay into the U.S. protection racket, signaling a move toward a world where control of the land matters as much as policing the sea.